Shanghai silver crosses $100 Aussie. When a metal breaks triple digits in one market, but trades 40% lower in another, you're not watching a price anomaly, you're watching a system fracture. The Shanghai premium just hit levels that haven't existed in modern markets. And what's happening right now in Asian vaults is sending a message Wall Street doesn't want you to hear. Because when physical metal starts commanding prices the paper market can't explain, someone is about to be proven catastrophically wrong. The question is, are you holding the claim or the metal? I'm John A.G. And if you've made it this far into your life, understanding that real information has real value, then you already know what I'm about to ask isn't just about a button. Hit that subscribe, not because I need the number, but because you need the signal when the next fracture appears. This isn't entertainment, this is early warning. And I want to know, where in the world are you watching this from? Drop your country in the comments. Because what's happening in Shanghai today might be happening in your market tomorrow. Now, let's get into why this matters. On a Tuesday morning in early 2025, something unusual appeared on trading screens across Asia. Silver, a metal most people associate with jewelry and industrial components, crossed $100 per ounce in Shanghai. Not in New York, not in London, in Shanghai. And that single detail changes everything. Because when a commodity trades at vastly different prices in different regions, someone is paying more for a reason, and that reason is rarely comfortable. The number itself seems straightforward. $100. A round figure, easy to remember. But what makes this moment significant isn't the number, it's the gap. While Shanghai silver touched triple digits, the paper price in Western markets sat nearly 40% lower. Traders in New York were looking at quotes in the mid-60s. London showed similar figures. Yet in China, buyers were paying 100. This isn't a small variance. This isn't a weekend anomaly that disappears by Monday. This is a structural divergence that reveals something most market participants haven't fully grasped yet. The global silver market, long assumed to operate as one unified pricing system, is beginning to split. Analysts who've spent decades watching commodity markets know what regional premiums indicate. They signal tightness, they signal urgency. They signal that in certain locations, physical metal has become more valuable than the contracts that claim to represent it. And when premiums reach levels this extreme, they're signaling something else entirely. They're signaling distrust. Consider what a buyer in Shanghai faces. They see two prices. One is the international benchmark, the number quoted on exchanges in New York and London. The other is what they actually have to pay, right now, to walk away with physical silver. The benchmark says 65. The vault says 100. Which price is real? For years, well, the answer seemed obvious. The benchmark was real. The benchmark was what mattered. Everything else was just local friction, taxes, premiums, minor adjustments. But when that minor adjustment becomes a 40% gap, the question flips. Maybe the benchmark isn't real anymore. Maybe the vault price is telling the truth. This matters far beyond silver traders. Business leaders managing supply chains need to understand this. Manufacturers who depend on industrial metals need to understand this. Anyone holding contracts priced off international benchmarks needs to understand this. Because what's happening in Shanghai isn't isolated to one metal in one city. It's a symptom of something larger. The traditional price discovery mechanism, the system that's supposed to tell the world what things actually cost, is starting to malfunction. Here's why that's dangerous. Modern markets operate on confidence. Participants trust that posted prices reflect reality. They trust that a contract for delivery will result in delivery. They trust that if they need physical metal, they can obtain it at something close to the quoted price. But confidence is fragile, and once participants stop believing the posted number represents what they'll actually pay, the entire structure wobbles. Shanghai buyers clearly don't believe it anymore. They're paying 100, not because they want to, but because that's what possession costs. And possession, in tight markets, is what matters. The premium gap reveals a fundamental shift in psychology. Buyers are no longer optimizing for the best paper price. They're optimizing for certainty. They're willing to pay more, significantly more, to ensure they actually receive metal. That willingness to pay premiums signals something critical. It signals that supply isn't as comfortable as official statistics suggest. It signals that delivery isn't as guaranteed as contracts imply. It signals that the world is quietly dividing into two categories, those who own claims and those who own metal. And in Shanghai, the metal owners are paying $100, while everyone else is still debating whether 65 is too high. This divergence didn't happen overnight. Premiums have been creeping upward for months, but crossing triple digits represents a psychological threshold. It forces a question that can't be ignored. If silver is worth 100 in the places that demand it most, why should the rest of the world pretend it's worth 65? That question is the beginning of a fracture. And fractures, once they start, rarely stop on their own. In financial markets, There's a concept traders rarely discuss openly. It's called the lie everyone agrees to believe. And for decades, the silver market has operated on one of the most elegant lies ever constructed. The lie goes like this: paper and metal are the same thing. A contract for silver and actual silver are treated as equivalent, interchangeable, fungible. This worked beautifully. Until it didn't. What's happening now in global silver markets isn't just a price gap. It's the moment when that carefully maintained illusion begins to crack. And participants on both sides start questioning whether the agreement still holds. Consider how the system was designed to function. A buyer in Germany wants exposure to silver. They don't need physical bars, they just want the economic benefit if prices rise. So they purchase a paper contract. Efficient, clean, no storage costs, no shipping delays, just a claim on silver somewhere. Meanwhile, a buyer in Mumbai wants actual metal. They need it for manufacturing, for reserves, for certainty. So they go to a vault, pay the premium, and walk away with physical bars. Both transactions happen. Both buyers are satisfied. The system hums along. But here's what the system requires to function. It requires that most buyers stay in the paper lane. It requires that the vast majority never actually demand delivery. It requires that physical and paper prices stay close enough that nobody questions the equivalence. And for years, that's exactly what happened. Now, something is breaking. The equivalence is dissolving. In Asian markets, buyers are increasingly refusing to play the paper game. They're demanding physical. And when enough buyers make that demand simultaneously, the system reveals its central weakness. There isn't enough metal to back all the claims, not even close. Industry analysts estimate that for every ounce of physical silver in vaults, there are dozens of paper contracts claiming ownership of that same ounce. Some estimates go higher, some conservative, but every estimate reaches the same conclusion. The paper market is leveraged, and leverage works beautifully, until everyone wants their collateral at once. That's what Shanghai premiums are really signaling. They're signaling that in certain regions, the race to claim physical metal has already begun, and the people willing to pay $100 aren't paying for silver. They're paying for certainty. They're paying to exit the paper system before it becomes obvious how many claims exceed how much metal. This creates a dynamic most commodity markets have never had to face. In a normal market, when prices rise too fast, new supply enters. Miners increase production. Recyclers ramp up operations. The system self-corrects. But there's a problem. Silver isn't just mined, it's refined, it's transported. It's allocated to vaults. Each step takes time. Physical constraints, real-world friction. And when buyers stop caring about paper profits and start caring about physical possession, those constraints become bottlenecks. Reports from industry insiders paint an increasingly tense picture. Refineries are running at capacity. Shipping times are extending. Vault availability is tightening. And most concerning, rejection rates on delivery requests are rising. Rejection rates. That's the polite term for what happens when a buyer presents a contract and demands their metal. And the counterparty says, no, not wait, not delayed, just no. Sometimes it's dressed up in technical language. Force majeure clauses, settlement adjustments, cash alternatives. But the core message is the same. You have a claim, but you're not getting metal. And once that starts happening with any frequency, the entire confidence structure wobbles. Because if contracts don't guarantee delivery, what exactly are they worth? The answer is becoming increasingly clear in Shanghai. They're worth whatever discount buyers demand to accept uncertainty instead of certainty. And that discount, right now, is 40%. This isn't a temporary arbitrage opportunity. This is a market trying to tell the world something critical. It's saying that the old pricing mechanism, the one that treated paper and metal as equivalent, no longer reflects reality. In regions where physical demand is relentless, the paper price has become irrelevant. What matters is the vault price. What matters is possession. And what matters most is whether you're holding a claim or holding metal. The fracture is widening, and the world is quietly choosing sides. Shanghai has already chosen. The question now is, how long before other markets follow? There's a moment in every financial crisis that historians later identify as the point of no return. It's not the crash itself. It's not the panic. It's the moment when the math stops working. And everyone pretends it still does. For silver, that moment might already be here. And most people haven't noticed yet. To understand why Shanghai is paying $100 while New York quotes 65, you need to understand something uncomfortable about how modern commodity markets actually function. They're not designed to deliver metal. They're designed to manage price. That distinction matters more than most realize. Consider the structure. On one side, there are exchanges, massive institutions facilitating billions in daily transactions, futures contracts, options, derivatives, complex instruments that allow traders to bet on silver's direction without ever touching physical metal. On the other side, there are vaults, physical storage facilities holding actual bars, real metal, finite inventory. The system works when these two sides stay connected, when paper prices influence physical behavior, when physical scarcity influences paper prices. But there's a hidden assumption that makes this connection possible. The assumption is that physical demand will remain predictable, manageable, that most contract holders will settle in cash, that delivery requests will stay within normal ranges, because if too many participants demand delivery simultaneously, the system has no answer. This isn't conspiracy theory. This is mechanical reality. The paper market operates on leverage. For every ounce sitting in a vault, multiple contracts claim ownership. This leverage allows markets to function efficiently. It provides liquidity. It enables price discovery across vast volumes. But leverage is a double-edged blade. It magnifies gains during calm periods, and it magnifies chaos when confidence breaks. What's happening now is a confidence break, not a complete collapse. Not yet. But a crack, a visible crack that's spreading. Asian buyers are demanding physical delivery at rates the system wasn't built to handle. They're not rolling contracts forward. They're not settling in cash. They're insisting on metal. And every time someone insists on metal, someone else has to find it. That search is becoming harder. Industry sources report that premium offers for immediate delivery have reached levels not seen in decades. Buyers willing to pay above market rates, significantly above, just to secure metal now rather than waiting. This creates a cascade. When premiums rise, it signals tightness. When tightness becomes visible, more buyers rush to secure supply. When more buyers rush, premiums rise further. The loop feeds itself. And the paper market, designed to absorb volatility, finds itself unable to suppress what's happening in physical channels. Here's where the mechanism becomes truly dangerous. Market makers, the institutions providing liquidity on exchanges, operate with risk limits. When volatility spikes beyond certain thresholds, they pull back, they widen spreads, they reduce position sizes. This is prudent risk management, but it's also fuel for acceleration. Because when liquidity providers step back, even modest buying pressure creates exaggerated price moves. And exaggerated moves attract attention. And attention brings new buyers. The system that's supposed to stabilize volatility begins amplifying it instead. Shanghai's premium isn't just reflecting local demand. It's reflecting the early stages of this mechanism activating. Buyers in Asia aren't paying 100 because they're irrational. They're paying 100 because they've calculated something critical. They've calculated that waiting, hoping price is moderate, carries more risk than paying the premium now. That calculation reveals a profound shift. It reveals that sophisticated market participants no longer trust the paper price to remain available. They no longer trust that contracts will deliver. They no longer trust that the system can absorb unlimited demand without breaking. So they're exiting. Not loudly, not with announcements, just quietly paying premiums and taking possession. And every ounce that exits the vault system is one less ounce available to back the remaining paper claims. This is the mechanism that breaks fractional reserve systems. Not government action, not regulatory intervention, just mathematics. When claim holders demand delivery faster than the system can provide, the leverage unwinds. And when leverage unwinds in commodity markets, the unwinding doesn't happen gradually. It happens in lurches. Sudden gaps, halted trading, emergency margin calls, forced liquidations. The 2022 nickel crisis demonstrated this perfectly. Within hours, the London Metal Exchange faced positions it couldn't settle. Trading halted, contracts canceled, years of precedent abandoned, all because the paper market encountered physical reality and lost. Silver hasn't reached that point, not yet. But Shanghai's premium is the early warning system flashing red. It's saying that in at least one major market, physical reality is already overriding paper pricing. It's saying the math has stopped working, and everyone is still pretending it hasn't. That pretense is what makes the next phase inevitable, because when enough participants realize the mechanism is broken, the race to exit becomes a stampede. Every major financial dislocation begins the same way, with a signal nobody takes seriously, a regional anomaly, a technical glitch, a temporary imbalance that experts assure everyone will normalize. And then, it doesn't normalize. It accelerates. Shanghai silver crossing $100 isn't the crisis. It's the signal that a crisis has already begun. And what happens next depends entirely on whether decision makers recognize what they're actually looking at. Because this isn't about silver, not really. It's about what silver reveals. Consider the broader landscape. For decades, global markets have operated on a fundamental premise. The premise that financial instruments accurately represent underlying assets. That derivatives track their reference points. That price discovery mechanisms function reliably. This premise enables everything. International trade, corporate hedging, supply chain planning, investment allocation. All of it rests on the assumption that posted prices mean something. But when physical and paper markets diverge by 40%, that assumption dies. And once it dies in one market, participants start questioning it everywhere. This is the consequence business leaders need to understand. Shanghai's premium isn't contained to silver. It's a leading indicator of systemic fragility across commodity pricing structures. Because if the paper-physical disconnect can reach 40% in silver, why assume it can't happen in copper, in platinum, in any leveraged commodity market where contracts vastly exceed inventory? The answer is, it can, and in some cases, it already is. Sophisticated institutional buyers have been repositioning for months, quietly, without fanfare. Increasing physical allocations, reducing paper exposure, shortening delivery timelines on industrial contracts. They're not doing this because of silver specifically. They're doing it because silver is showing them what comes next. What comes next is repricing, not the gradual repricing markets experience during normal cycles, but violent repricing that happens when confidence structures collapse and everyone tries to exit leveraged positions simultaneously. For businesses dependent on silver, either directly or through supply chains, this creates acute vulnerability. Manufacturing operations that assumed stable input costs suddenly face procurement chaos. Component suppliers who hedged using paper contracts discover those hedges don't deliver physical metal. Companies holding inventory valued at benchmark prices watch real-world replacement costs surge 40% higher. This isn't theoretical risk. This is operational reality in Shanghai right now, and Shanghai is just the beginning. The currency implications extend even further. Silver's role in the broader de-dollarization trend cannot be ignored. As nations diversify away from dollar-denominated reserves, physical commodities become strategic assets, not financial instruments, not tradable paper, actual metal in actual vaults under actual sovereign control. When China pays $100 for silver, while Western markets quote 65, they're not overpaying. They're securing tangible reserves while the opportunity still exists, because they understand something critical. In a world where financial claims increasingly disconnect from physical assets, possession becomes the ultimate advantage. The strategic question for businesses operating globally is stark. Are your contracts priced off benchmarks that may no longer reflect reality? Are your hedges backed by actual delivery capacity? Are your supply chains vulnerable to sudden repricing events? These aren't abstract concerns. These are immediate risk assessment requirements. Because when Shanghai's premium inevitably influences other markets, when New York and London can no longer maintain the fiction that 65 is the real price, the repricing won't happen gradually. It will happen overnight. Contracts will be rewritten. Margins will be called. Supply agreements will be renegotiated. And businesses that assumed stability will face chaos. This is what makes Shanghai's crossing of $100 so significant. It's not about the number. It's about what the number proves. It proves that paper markets can lose control of price formation. It proves that physical scarcity can override financial leverage. It proves that the old mechanisms, the ones that made global commodity markets function smoothly, are breaking down. And once that breakdown becomes undeniable, the entire commodity pricing architecture requires reconstruction. But reconstruction takes time, and in the gap between breakdown and reconstruction, there's volatility, there's uncertainty. There is risk that sophisticated actors are already pricing in, while others remain unaware. The business leaders who understand this moment aren't asking whether silver will hit 100 in Western markets. They're asking what happens when it does. They're asking what happens when the gap closes. Not through Shanghai falling, but through New York rising. They're asking what happens when every leveraged commodity market faces the same confidence test silver is facing now. And they're positioning accordingly. Because the uncomfortable truth is this: Shanghai isn't an anomaly. Shanghai is a preview of what happens when markets built on leverage meet demand that won't accept substitutes, when claims meet metal, when paper meets reality, and when enough participants realize that the price on their screen but was never the price they'd actually pay.